right, welcome into Commodity Wrap. I am Scott Shelby, otherwise known as the Cow Guy. Thank you very much for tuning us in on this Wednesday. It's WASDE Day. WASDE and Wednesday, they go together, don't they? We've got a great guest for WASDE, super guest. It's Mr. Brian Hoops. He's with us. Brian, thank you very much for coming on the show. A great day to have you on, by the way. Let's give us your 30,000-foot view of what's been happening.
Hey, you look at this WASDE report and the ethanol production report that came out today. I think it's all very positive for the corn market and for soybeans as well, Scott. Even the CPI number this morning I thought was friendly from the standpoint. It caused a little bit of a sell-off in the dollar index initially when it happened. Dollar did come back by the end of the day, but normally you have a weaker dollar. That's usually bullish for commodities, and we've seen gold and silver trade sideways for a good 30-day period before they broke out to the upside, and maybe kind of a matter of time here before we see a similar pattern in corn and soybeans. Now, we have harvest in front of us, but I just don't know that you're going to have a whole lot of harvest pressure that's going to drive prices lower. I think with the report that came out today, lowering of corn yields for both corn and soybeans, it really tells us that we could see additional yield losses in the case of corn going forward. Soybeans, the rains that we've had during the month of August should be really beneficial for that crop. So I think you're at least stabilizing yields there, maybe increasing it. But one thing that you take away from all the numbers today, and I guess I'm not surprised to see the USDA lower yields but increase acres in the same report day. One thing you really take away from this is our production numbers do not meet the demand for both corn and soybeans. Our demand numbers are trending higher than the crops that we're going to produce this year, and I think that sets us up longer term, very friendly for agriculture in 26 and into 27.
Yeah, I mean, that's probably my biggest takeaway. I love the fact that we have a demand market, right, because the fleeting weather markets are kind of crazy, but when you get a good solid demand market, you can gain some steam and build off of it. As far as the yield goes, I mean, they really dropped that corn yield, and maybe we're there, maybe we're not. We debate these things until our heads cave in. But I guess that means I would say my gut instinct is, Brian, that we could probably suffer a little bit of loss of bushels here if we get real hot and dry in August, and it'll probably still keep that number about the same. But I just feel bullish. I feel like we've got a good market underneath this market when it comes to demand. I'm just disappointed that we're still 20 some odd cents away from, say, $5 and $12. That's what I don't like about it.
Yeah, I think we're going to get there eventually. In the case of soybeans, it may take a much longer time than the corn market to see this rally, just because the traders in the back of their minds know that these good rains across from Nebraska through Ohio, it's going to help the soybean crop out, at least stabilize these yields, if not improve them. And in the case of corn, there's some pretty sizable yield losses, especially in the Western Belt. And USDA did account for that compared to last year. If you look at a map of our state by state, how they performed this year versus last year, that Western Belt solidly in a major decline with very few states showing an improvement. But one thing to note, last year we had an 186.5 bushel crop. This year the USDA said 180.7. Well, that would be the second time in history, the second largest yield we've ever had in history, if this holds true. And I think there's a lot of producers in that Western Belt that'll tell you this is far from their second best crop in history. This is one of their poorer crops. And so we may have some adjustments going forward that'll eventually kick us to $5 and above. So I said earlier, I don't think you're going to see much harvest pressure. I think that is the case because you will see very little farmers wanting to part with this crop. They're more apt to store as much as possible, let basis improve, and see if prices can improve through the winter and into the spring time frame, and only sell what they absolutely have to, and probably re-owning a lot of that back on paper.
Yeah, that's what my next question is exactly going to be that. I mean, there probably won't be a lot for sale then on the way up, is what you're kind of telling me. It might be kind of a little bit of a sparse trade.
I think that's going to be the case. It's the funds are going to have an appetite, I think, to buy this crop. In fact, today alone, StoneX estimates that they bought 80,000 contracts of corn today. So massive buying in the corn market. And there may be very little for sale. Farmers selling, I think, is going to be very limited to cash needs, maybe lack of storage, that sort of thing is really the only reason that they're going to really try and aggressively would sell anything. I just think they're more apt this year from talking to clients to hold on to as much crop as they possibly can.
Yeah, I mean, so farmers are, just by nature they're inherently long. So you're probably not telling them to get longer on the rally, right? But you're probably saying, hey, let's look at maybe waiting and seeing what happens here, and maybe sell something if we get closer to 5 or 5.25. I know that some guys start to get profitable up in that area, but not a lot. I mean, they need to see it a little bit better, especially cash.
Especially in the cash, yeah. If we got $5 cash, certainly different than $5 on the board. That I think would attract a little bit of selling for some cash flow needs. We do need to convert and merchandise the crop into cash at some points during the year. And I think it makes some sense to do that, especially if we get into a situation where, you get that type of cash, basis has narrowed up. There'll be some product being let loose throughout the year, but I do think the merchandisers are going to have to work for it this year with tighter basis when they need that crop, because it looks like our exports are going to remain good. Our demand for ethanol is going to remain real strong. And, if we bring more cattle across the Mexican border, we're going to need more feed demand here in the United States.
All right, great stuff. Stay right there, though. We need to go away and pay for this. We're going to pay some bills. We're going to come back and talk more right after this.
All right, right back to it. 3, 2, 1, go.
All right, welcome back to Commodity Wrap. I am Scott Shelby, otherwise known as the Cow Guy. We're with Mr. Brian Hoops. He's the president of Midwest Market Solutions. Brian, thanks for sticking around. Great segment, the last segment. I wanted to kind of expand on that and then maybe move into some of the livestock. But we had a WASDE today. We talked a lot about corn there, maybe a little bit about beans. But is there anything else in that report today that we got that was a little bit surprising? I mean, we added acres, too. What say you?
Yeah, I don't think adding the acres was necessarily a surprise. Kind of the way the USDA has operated in the past, it seems here, is they don't want to dump a lot of bullish news and information on the markets all at one time. And they kind of tempered a lot of the big drop in yield by increasing acres. And maybe that's just a coincidence and maybe it's not. But, we did increase acres. It looks like a good thing we did because we have smaller yield potential. Otherwise, we'd be seeing prices really move higher and in a sharp fashion. And usually those rallies are not the best. It's more of a slow build type rallies are usually the best ones when you have strong demand, a demand-led type rally. And that's what it looks like this is. It's a demand-led rally, kind of fueled by a little smaller than expected crop, but still second largest corn crop we have on history. The wheat market is one that I think you look at the numbers, there's really nothing too exciting or real bullish about this market. We're not exporting a lot of the product. We're going to find some fun buying interest along with corn and beans. It's going to spill over into the wheat, no doubt. I have a hard time believing we're going to meet the carry that's offered when it's all said and done for the wheat market.
I mean, there's just stories all around them, whether they may be big or small, anywhere from the Kerch Straits to, how hot it's been in Europe too, right?
Right. Yeah, it's not just here in the U.S. It's been hot and dry, especially the Western Belt. But out in Europe's been extremely dry. I'm here more of the winter wheat plains areas. It is very hot. It is very, very dry. We're maybe too early to start talking about seeding winter wheat for this year. That's usually in about a month from now. But if this ground is getting baked, 95 to 100 degrees for 3-4 weeks with no rain, it's going to be a really hard ground to try and plant into until they get some of that moisture. So maybe producers respond by planting less wheat and more corn and soybeans next spring is certainly a possibility.
Yeah, there's a lot to talk about there. I mean, when I went back to the Europe thing, I lived in England for 16 years, and I'll tell you, I mean, they don't get stuff like this. I mean, they're a little bit further north than the U.S. is, or a lot of the big parts of the U.S., and I mean, I never had a house that had air conditioning. You didn't need it. And I had probably owned 3 or 4 cars when I was there. Not one of them had air conditioning in the car. It's just not the done thing. They don't really get that hot. So this was really an anomaly for them and across all of Europe. And it just goes to show you that even they can get some outsized hot weather. All right. That aside, let's use that as a segue into we had Dr. Gerald Peel on Market Day Report here on RFD TV today, talking about pasture land, and it's dry, and poor to very poor. That's not going to help replenishing the herd. But we did have lower prices today. What's your little macro view of what's been happening in the meats?
Oh yeah, we did see lower prices, and maybe part of that in the feeder cattle complex was higher corn prices. Maybe it's partly because the report was friendly, especially for corn prices to move higher. That of course is a big component of feeder cattle and cattle inputs is the feed cost.
Yep.
Yeah, I agree. Definitely, the dryness in the plains is not going to encourage any expansion plans whatsoever. Hay supplies are going to remain very tight. Last year at this time, we had about a $40 rally in our cutouts from late July, early August into Labor Day, and we're hoping we get some sort of bounce like that again, because this would give us an opportunity for producers who maybe haven't done any hedging to look at starting to do some of that. There was a lot of hedging done in 25. Seems like in 26, people got burned and didn't want to do any hedging, and this is the time when they probably should have been doing it, as we are going to increase those supplies across the border. It won't be until 27, maybe the second, third quarter before we get full supplies moving across, but it is happening and it will happen, and so producers are going to have to face that reality that we're going to have more cattle here. We're going to need to increase these packing facilities, increase packer margins so they have the ability to increase kills and add more shifts. So it all has to work together, and we do need a rally in these cutouts, and they were higher at midday, so that was a little bit encouraging.
Yeah, it's interesting. As we get higher and higher, and the price of beef, cattle on the board goes up. It's not necessarily making them a lot more money. It's like in corn at $8. The reason why corn's at $8 is there's not that many bushels around. So if you're in the volume business, even though it's at $8, you're not making as much money because there's just not as much volume. When it comes, back to cattle and replenishing the herd, we're going to have to introduce new demand, I think, to really give us another leg higher. Is that possible?
I think we can open up some more export markets once we get more supplies of beef here in the U.S. Certainly, we've lost Mexico because they were slaughtering their own animals and weren't buying as much product from us. We were exporting more corn to Mexico to feed those animals. But yeah, if we bring those animals back from Mexico into the U.S. to be slaughtered, I think we can increase our export business there. Our imports hopefully would slow down as well, as we don't need to bring some animals in. So I think those fundamentals are going to shift a little bit. And I think we have seen an improvement in our export sales reports in the last 2 to 3 weeks as these prices have dropped substantially. There look to be a lot of buyers at these lower levels. Whether we can sustain that demand at higher price levels, we haven't been able to do it yet, but hopefully we get an opportunity to find out if we can.
All right. Great stuff as usual, Brian. Really appreciate you coming on. Brian Oops, president of Midwest Market Solutions. Thanks for being on the show. We'll see you or hear from you again soon. Thanks for being on.